Hi, my name is Hillary Sunderland, and I'm the Chief Investment Officer of Beacon Wealth Consultants. And this is your March 2021 market update. Well, last year at this time, we were only a few weeks into what would turn out to be a year of social distancing and wholesale changes to life as we know it. Now, a year later, with the first quarter of 2021 in the books, I will say it's been a better start than the first quarter of 2020 was. From a returns perspective year to date, and starting on the left, large cap domestic stocks returned 6.17%. Small cap stocks have returned 12.7%. International developed stocks, which are stocks in countries such as Japan and Australia and Germany, returned 3.48%. Emerging markets, which are stocks in countries such as India and China, returned 2.29%. Bonds sold off as yields moved higher and stocks rallied. In fact, Treasury bonds posted their worst quarterly performance in more than 40 years, as investors continue to bet on a strong U.S. recovery from COVID-19. Year to date, the Barclays Aggregate Bond Index, which is a measure of the performance of investment grade domestic fixed income, returned a negative 3.37%. For our clients, it's important to note that we do actually manage our fixed income allocation. So while the broad bond index is down year to date, all of our fixed income funds outperform their benchmarks for the quarter, with some even experiencing positive returns. And we are actively investing our portfolios to help hedge a rise in interest rates. And then finally, on the right-hand side there, the Bloomberg Commodity Index was up 6.92%. Commodities had a pretty strong start to the year as oil bounced on economic reopening plans. And there was also a gridlock in the Suez Canal, which also caused oil prices to jump. Today, I want to take you through a few big picture themes as we look ahead. This has been a very different economic cycle in that it was our first ever government-induced recession in an effort to prevent a humanitarian crisis. We are coming out of recession driven by lockdowns and voluntary social distancing rather than underlying economic and financial strains, which makes it very unique relative to history. This is a chart of economic growth in the U.S., and you can see the huge drawdown in economic activity in 2020, followed by a very sharp snapback, which has since leveled out a bit. What we want to see is the economy picking back up to trendline growth, which is the blue dotted line there. And getting past this pandemic is a key way to achieve that goal, since the downturn was pandemic related to begin with. So let's take a look at where we are on the pandemic front. It's estimated that about 75% of people over the age of 65 have now received at least one vaccine dose. And as you're probably well aware, those over 65 years old are much more likely to require hospitalization should they be infected with COVID. And also, hospital capacity was one of the main restrictions on economic activity. As hospitalizations increased around the country, that's what led many areas to lockdown. So an abatement in cases, especially those over the age of 65, is very beneficial for our economy. And as you can see here, we're making good progress. As shown on the left, as vaccines have been rolled out, fatalities, which is the gray line there, have been mostly on a downward trend. We're now down to approximately 1,000 fatalities per day from a peak of around 3,500 fatalities per day. And the recent pickup in the vaccine rollout and supply leads us to believe that reaching herd immunity over the next few months is possible. The chart on the right shows the progress toward herd immunity, and we are approaching the zone with which herd immunity may be achieved. Note that this is based on the assumption that variants that are causing massive spikes in COVID-19 hospitalizations and fatalities in other countries, such as Brazil, won't take hold in the US. And that's why it's important for the vaccines to roll out as quickly and to as many people as possible. The firm Good Judgment forecasts a 98% probability that 200 million Americans will be vaccinated by July of 2021. The UK will likely be on a similar timeline as their vaccine rollout has been going fairly well, with continental Europe trailing by a few months. So with that vaccine rollout, we have seen a recovery in mobility in the US. This chart shows the huge drop off in economic activity in various sectors since the pandemic began. And as you can see, we've been on an upward trend back to normal in areas such as dining and travel, which is very positive for our economy. Now, we still have a bit of a way to go to get back to pre-COVID-19 levels, but we have seen a lot of activity picking up in areas such as restaurants and travel as vaccines have continued to roll out. So with that backdrop, our baseline view is for a strong recovery across the world. We expect a prolonged period of above-trend global growth that will last well into 2022. Initially, the U.S. is likely to lead given the scale of the recent stimulus bills as well as the relative success of the vaccine rollout. However, we do expect other regions such as Europe to catch up in the second half of 2021 as pessimism surrounding vaccine delays should abate later in the year in those regions. On the interest rate front, the Federal Reserve maintained its positioning of low interest rates for the foreseeable future following their March meeting. While the Federal Reserve is keeping short-term interest rates low, longer-term interest rates have ticked up on concerns with inflation. However, we do believe that at this juncture, interest rates will remain fairly range-bound over the next few months. For you, what this means is that you should expect the housing market to likely continue to boom as interest rates remain low. And unfortunately, for your savings accounts, you'll likely continue to earn negative returns after accounting for inflation, as the Federal Reserve does not seem to be in any hurry whatsoever to raise interest rates. What does this mean for you then as an investor? On the equity side of the equation, the low interest rate environment, economic reopening, and fiscal stimulus should continue to fuel equities. Remember, though, that markets do not go up in a straight line. There's always bumps along the way. That's a natural occurrence. And so you should expect there to be some pullbacks and even corrections as we continue with the reopening and continue in this new bull market environment. The next priority of the Biden administration is an enhanced infrastructure deal, partially funded by higher taxes. And this may create headwinds for company earnings because he is proposing increasing the corporate tax rate. However, we think the final tax outcome across the board will probably be more modest than what's currently proposed, but it is something we are watching closely. We're still in the very beginning of talks concerning this infrastructure package. Parts of the equity market are much more attractive than others, such as high quality small caps. So we are overweight the areas of the market that appear to be attractive based on, where they're currently trading. On the bond front, despite some parts of the bond market struggling year to date, bonds continue to serve as both a store of value and a potent hedge for risk assets in terms of overall asset allocation. Looking ahead, returns for bonds are likely to be very muted, which is why we're currently underweight bonds. There are pockets of the bond market that are much more attractive than others, and we are focusing there. Additionally, we have a good portion of the portfolios allocated to alternative investments. So alternative investments are investments that can offer positive returns regardless of the direction of the equity or fixed income markets. Those have been very beneficial throughout the first quarter as interest rates ticked up. But again, we are actively managing those positions on behalf of our clients. I hope that this update has been helpful for you. We thank you for your continued confidence, and please reach out to us with any questions that you may have.